This is Adam Olsen, Embark's accounting advisory practice leader, and you're listening to Accounting Matters. I'm welcoming back to the studio today James Durrenburger, a senior director out of our Dallas office, to come here to chat about a topic that I think is really on the tops of a lot of people's minds these days, which is the current economic uncertainty, the economic outlook, and how really an uncertain economic environment can bring to light many accounting and reporting considerations. So James, welcome back. Thanks for joining me today.
Thank you. Thanks for having me back.
running one man down with Zac being out, but I know we've got a lot to talk about, so I'm happy to jump into it. So I wanted to start our discussion today just maybe talking a little bit more at the global macro level and just kind of helping set the stage. And I think it's fair to say that unless you've been living under a rock these days, I think there's been so much chatter over the economic uncertainty.
Absolutely.
It's a big buzz, a big part of the conversation, especially throughout most of 2022. If you think about at the start of this year, we were just kind of rebounding, both from a US and even a global economic perspective of, getting back on track from, the past 2 years of COVID and all the setbacks we had obviously related with the COVID outbreak and everything that came from that. But it's almost like as soon as we just got out of COVID, starting the new year fresh in January 2022, it was only a month or so later that we then have this big geopolitical upending with the Ukraine and Russia conflict that's still ongoing. And a lot of people think about Ukraine, Russia being a very regionalized thing, which it is, right? There's a very particular part of the world that's a direct impact to, but the broader implications that has on a global economy, I think is being felt, across the globe for sure.
Absolutely, yeah.
Especially when you think about the region being a large export of global energy, exports of other, needed materials, so certain metals, food staples, et cetera, that come from that region, causes quite a rift in the global economies. And then even while we think about just geopolitical concerns, I think another common factor that we hear a lot being talked about is around just supply chains. I mean, supply chains were strained during COVID. And then, as we started to emerge from COVID, I think the consumer buying shot up significantly, but supply chains never really rebounded well from that.
Right.
So we see a lot of stress still on the supply chain issue globally, and that obviously leads to price increases and stresses on prices and inflationary pressures and things of the like. And then I think it's fair to say you can't really have a discussion around economic uncertainty without talking about inflation. Because I think that's the biggest news headline catcher is what's happening with inflation metrics. And then consequently, when central banks react to inflationary concerns, their strategy they most often use is hiking interest rates. And
that's right.
Everyone, when they hear a hike in interest rate, I think it does cause a panic, not just to consumers, but also to investors and the like. So a lot going on right there. So I guess with all that said, from a global perspective, James, maybe you can share what is the U.S. current outlook? Does it mirror a lot of what we're hearing, globally, or are there some specific nuances or what's the latest going on with kind of the U.S. economy that analysts are talking about?
Yeah, certainly. And, we look to our economic genius minds, the Federal Reserve, and more specifically, the Federal Open Market Committee. So they just actually met and had a press conference on November 2022 recently. So we're going to look to the Federal Open Market Committee, and they just recently met in early November. And the Federal Reserve Chair, Powell, gave some insights on the economy. So I'm just going to go through briefly and summarize what he said, because I think it's very important. So as you probably have heard, the Fed adjusted their interest rates by 75 basis points. So that is actually an increase of 3.75% since the beginning of the year. And remember, they're tasked with trying to stabilize prices. And so this is the tool that they're using in order to try to get inflation under control. And so they did say that for the last 12 months, ended in September, that we had inflation of 6.2%. So inflation is still running higher than the normal, on average, 2%.
Normally around 2%.
That's right.
The average people have been using for a long time as the constant barometer, and that's obviously been upended a bit this year. So
that's right. So prices have increased. We've had inflation. There's a number of factors that are driving that. in inflation. And so we did experience growth this last quarter. So there's been a lot of talk and a lot of, I guess, pessimism really in the economy that, yeah, we're headed toward a recession, but we did actually have economic growth. But we have seen it slow. So the housing sector has weakened significantly. Obviously, interest rates are rising. It's more expensive to enter into mortgages. And so that has foregone people into purchasing homes. And so that slowed down the housing sector. Also, it's put a weight on businesses with fixed investments.
Okay. What about unemployment? How's that looking?
So actually, unemployment is still very low. And so it is at a 50-year low of job vacancies are still pretty high and wage growth is elevated. And Chair Powell seemed to stress that in the last meeting, like that it's really a tight market. And so, that's another input I think they're looking at into saying like, okay,
a little hope in like the horizon potentially is that you've got all these bad things going on, but there are a few good data points out there. And like, I think strong unemployment numbers are one of those. And then there still seems to be, consumer spending is still there. Like it is slowing down a bit, but it's not like it's come to a halt.
That's right. There's still strong consumer spending.
So, a lot of people, I think, try to throw around like the R word, which is like recession. Are we in one? Are we not in a recession? What is your take on that? Or what are analysts saying? Like, I think there's a certain viewpoint that some people feel like we already are there or we're heading towards one. But what is like the actual data showing on that?
So, like I said earlier, the actual data shows that the first 2 quarters of the year, there was contraction, but there's actually expansion in the last quarter. So technically, we're not in a recession yet.
Yep.
But like I said earlier, we are seeing some indicators of a slowdown. So it's possible that we could get into recession, but it's also possible that we may not. So we're still in this weird, uncharted territory where we've had this global pandemic, and then we've had which has caused these unique constraints on our supply chains, right? That you don't have control over, and so I think it's still haven't seen what's going to happen.
Yeah, and I think there's a different viewpoint when you've got actual economists. Like there's a definition of what technically qualifies as a recession, and then you probably have like your Facebook economists where people are making their own conclusions, and it's because like they're paying higher prices for certain things where they're seeing inflation or obviously the interest rates we talked about, so they understand borrowing is more expensive, so to them it's like we're there already. So
the price at the pump, I mean, the Ukraine conflict with Russia has caused oil prices to increase, right? And so that's something that people see very well.
So what about if we're looking kind of beyond the current state or even like early next year, but maybe like a broader outlook? Like what have you seen a lot of indicators or like consensus on what analysts think the maybe longer, broader outlook is for the U.S.?
Well, so I think the key takeaway is there's still a lot of uncertainty, right?
Okay.
I mean, even the Fed, they like to provide clear direction, but it's uncertain on how high they're going to go. Now, Chair Powell did say that the rate of increasing the interest rates is probably going to start slowing, but they're not there yet. So they're seeing how the markets are going to react, how the various economic indicators are going to react to this last set of increases. And they're basically have said they're going to go month to month and looking at it. But they're still committed to the long-term goal of providing employment and then stabilizing prices. And so until they get to that stabilized price where inflation gets down to their normal level, they're going to continue to raise the interest rates. But there's still a lot of uncertainty in how that's gonna happen and how long it's gonna take.
Yeah, I guess one other like aspect I would add, we obviously do work a lot with a lot of companies that are operating in the capital market space, and I think when you think about from a deals perspective how all the economic uncertainty has caused, I mean, really like a pause or like that. It's almost like the capital markets has kind of gone into hibernation when we think about the volume of IPOs and SPACs, particularly in 2022. Especially when you think about the past 2 years where there was such a boom. SPACs were like the poster child for entering the capital markets. There were SPACs popping up all over the place, lots of IPOs that were taking place. But since things have kind of done a little bit of a 180 from then in 2022, we've seen private companies that maybe were thinking about going down the IPO path, kind of putting a pause on things because it's a more challenging market to go and potentially try to do an IPO and maybe not flop. Obviously, there's a lot of market volatility. If anyone checks their retirement portfolio, you can definitely see probably some shocks there, and that obviously impacts valuations. It impacts a lot of uncertainty on whether a company maybe wants to go forward with an IPO. And then I will say, like, another interesting thing that, you've got all these like kind of macro events going on, but just with SPACs particularly, the SEC even during the year has kind of put a little bit more of a focus on SPACs with some of the regulations that have kind of dampened some of the enthusiasm. I think investors and even like financial institutions that were maybe operating as underwriters for SPACs just kind of taken a little bit of the wind out of their sails because now SPACs are really being viewed as more of a riskier investment vehicle. Not to say they're going away or anything like that, but I think that there's more scrutiny for sure, and so that's put a pause on the SPAC market itself, and I think like what we're seeing, particularly as well with SPACs is that it's a very saturated market, and so it's also no surprise that new SPACs aren't entering into the market because there's so many SPACs that were formed that actually haven't merged with anyone. They haven't found a good target. And that could also be just because valuations are kind of suppressed right now. So a lot of private companies aren't wanting to merge. And so there's a whole like calamity of factors that are coming together that just from a deal side, I think has also impacted the volume of work and volume of transactions that we've seen in that space. But I guess with all that said, I think we've kind of like laid out the landscape here as far as what the economic environment looks like, what people are dealing with, what companies are dealing with. So I know the main focus of this conversation is really to look at some of just the accounting and reporting considerations that tend to arise when you have a lot of these events going on. So let's pivot to some of that discussion. So James, like, I guess maybe what are a few key areas that, we want to highlight today that companies probably need to just keep in mind, just given everything that's kind of going on around the broader economic environment?
Yeah, I mean, this is a great time. We're approaching calendar year end. So as we're approaching calendar year end, companies are getting ready for the annual financial statements and the annual audits. And so some key areas that I think that we'll need to pay close attention to and just a little bit more scrutiny. There'll be asset impairments, revenue recognition, and credit losses, any credit loss reserves, compensation arrangements, so debt and liquidity, and especially going concern analysis at the end of the year.
Okay. So let's maybe like dig a little into each of those and just highlight some of the reminders that we want to kind of put out there for our listeners. So let's start with asset impairments. I think when we think about asset impairments, I think the first thing that comes to mind is just figuring out, okay, which assets do we have at our business that we need to think about for a broader impairment assessment? Because I know we've talked about asset impairments on a few different episodes on this podcast. So there's definitely a lot of good information that we've talked about previously if people have checked those out. And if you haven't, just a reminder, there are different models for different asset types. So
that's right.
Maybe one thing you could start with, James, is just summarizing kind of like some of the major asset classes and maybe what the impairment model looks like very high level.
Yeah, so in the impairment model, there's basically three asset types. The indefinite-lived intangible assets. So for this group, it's basically all the intangible assets besides goodwill. And so we want to look at impairment. It's done on an annual basis or whenever triggering events occur. So within practicality, we usually assess triggering events on a quarterly basis because that's our, typically when we do our other reporting cycles, quarterly and annually. And so the test in itself is it's pretty simple. It's just a one-step test looking at the fair value of the asset compared to the carrying value.
Yeah, and that's for indefinite lived intangibles, right?
Yes,
Okay.
indefinite lived
Yep.
and intangibles.
So what about intangible assets that have a finite life, or your fixed assets? What does the model look like for that?
Yeah, so the long-lived assets. So basically, we look at the impairment when a triggering event occurs, and so here there's multiple steps. So first, we look at if there's a triggering event, and then we focus on recoverability, and then from there, if it indicates that the asset has been impaired, then we actually focus on measuring the asset.
Okay. Yep. Yeah. So it's test for recoverability. If we don't recover, it doesn't look like the asset group is recoverable, then we'll measure that impairment loss for the asset group itself.
Yep, that's right. And while part of the analysis is looking at the asset group, you probably won't have to redefine the asset groups from the uncertainty of the economy. But if you are considering transactions or you're changing the nature of your business from this time point, then you might have to reassess.
Yeah, like a restructuring activity could potentially change the way you assess your asset groups. Yeah, good point. And then what about the last? You said goodwill.
Yeah, for goodwill, it's similar to the indefinite lived intangible assets. I mean, it is indefinite lived unless you're a private company, you take the private company option.
Right.
But here we look at impairment on an annual basis, or when triggering events occur. So, again, a triggering event could be any of the factors that we're talking about now in the economy. And so we can talk about that here in a minute. But then if there is a triggering event here, it's a test where you're looking at the reporting unit level and then measuring the fair value against the carrying value to see if impairment has occurred.
Yeah. So we kind of going through that, we talked about each of those things have like a trigger component.
Yeah.
If some companies may have actually already evaluated impairment, during 2022 in an earlier quarter or an earlier time period or something, just depending on the circumstances. But for those that haven't, and they have an annual impairment test, maybe the trigger aligns with their annual test. It just happens to be the case. But if a company is trying to think through whether they need to do an impairment test, for example, for fixed assets, which is only trigger based, like what are some common conditions or events that companies would think about in the context of whether or not a trigger is quote unquote been met?
Yeah, so the first one, and I'm just going to go through some notes here, is an increase in raw materials, labors, or other costs. Now, a lot of companies are experiencing that right now. So that is something that you probably want to put a little bit more detail in and look at how is the company been impacted by the increases in material and labor, because labor has been increasing.
Yeah, and particularly on like impairments where you've got, a lot of times it's a cash flow analysis, right? And so like obviously increased cost reduces the cash flows and has an impact there. And so that could, obviously yield a different result from just that alone.
Yeah, absolutely. And like you said, negative cash flow or history of negative cash flow is another triggering event. That one, if you do have a big increase in some of your supply or constraints because you cannot get materials in order to build your end product, or if that's it, or if you're in a service-based industry and you don't have people to perform services, your negative cash flow.
Yeah, and I would say even like if companies have been like tracking their cash flows during the year, like what actually happened maybe versus what their forecast was month over month, and you've been missing it consistently or something, that's probably an indicator as well that like that's a negative cash flow like trend you're seeing as well to keep in mind. Right,
absolutely. Another one is a change in the legal or regulatory area factors, political factors or business. So, if there's any impacts from the conflict with Russia and Ukraine or any other regulatory impacts like price caps on gas. So, some oil and gas companies have experienced that where there are other countries where because the price of natural gas has increased so much that the country has actually put a price cap. And so that's something to consider. as well. And then changes in key management. Oftentimes you have a individual that is really the success factor for an area of the business. And so if there is a turnover of that critical key person, that's something you have to really think about. Like, is that going to cause a trigger event for impairment? Another one is like market conditions, deterioration in environment that the entity operates in. So that could be, is there another competitor that's come in that's really gonna take your business away, and you have to assess whether there's been impairment. It could be labor market conditions. And we mentioned labor earlier, but that's part of the environment you're working in. Macroeconomic conditions.
Yeah, that's probably a big one, right? I mean, that was, most of our conversation up to this point is there's a ton of macroeconomic conditions. So it's likely one of those alone could be considered, enough to say a triggering event's occurred, depending on your business, the location, or the impacts of any of those events.
That's right. And I think, as we're going into the end of the year and we're doing this analysis, I think most companies will have to provide some more information and discussion on, what is the impact of these economic events? How is it impacting the company? How is the company responding to it? That maybe it's not a triggering event because we have these other levers in place, or we have these other plans in place. So I think if you don't put that in, you're gonna see more questions from your auditors because they're aware of the economic environment as well. And just like during the pandemic, when we had to go through and provide more information, we're going to have to do that again here with this impairment analysis.
Yeah, I think another thing just to mention is obviously there's a lot of judgment with a trigger, and it's a qualitative assessment, right? Holistically look at all the different factors. This is just some of the suggested ones. If you actually go into the guidance, they have also kind of examples of common triggers, but they also acknowledge that there could be other things that are more specific to you that you wouldn't want to necessarily overlook. So I think that's important to also keep in mind. One thing I guess, a question is around market capitalization, especially when we think about the volatility in the stock market. Because I know the guidance also has for goodwill specifically, when you're thinking about impairment, that sometimes a sustained decrease in share price could be a potential trigger as well. But if a company's market capitalization is below its book value, is that circumstance alone enough to say a triggering event is required to do an interim goodwill impairment assessment?
It could be, but it's not an absolute. I mean, the market capitalization does or should reflect in an efficient market, right? The expectations of the cash flows by all the market participants. But our threshold is actually more likely than not. And so companies should consider, what is driving the market capitalization decline and what factors is it? Is it temporary decline? Is it due to certain other factors, or is it a permanent decline?
Yeah. If it's a sustained decline that's going to impact you, it's probably more likely a trigger than something that is, a blip itself. So, a sustained decline, if it's driven all by, customer demand decline, then probably that could be an indicator, because that would probably fall back into some of these other, industry or market or macroeconomic conditions that we just walked through that customer decline would satisfy. So let's wrap up impairment there. And then I think the next one you mentioned was that, economic uncertainty could also cause some implications around revenue recognition. And then on the related balance sheet side, it could have impacts maybe around credit losses as well on the receivable side. So I know step one, if people are thinking through ASC 606, step one is all about identifying the contract with the customer, whether that exists, because you need to have that step. You need to have a contract that exists before you can move forward. And so the guidance is explicit about different things that are necessary to say that a contract exists. But one of those is around evaluating collectibility.
Yeah.
And so, if we think about everything that's going on, I don't think it's out of question to be this is likely probably an area that could be impacted, right? Collectability itself, is that fair to say?
So yeah, it very well could be. Like you said, in order to recognize revenue, a company has to conclude that it's probable that you're going to collect substantially all of the consideration that's listed in the contract. And so, I mean, realistically, you should take a good look at your customers and reassess it and assess whether those economic environments have impacted them, because that'll impact whether you record the revenue or not.
Yeah, and if you don't have, like, if you don't feel like collectability is probable and you're getting cash, then like you can't really do anything with it. You more or less have a liability on your balance sheet for the cash you got, because until you truly satisfy that kind of collectability criteria for step one, you can't really move through the rest of the rev rec model. So I think that's good to point out. But let's say a company, they know their customers are struggling or whatever to make payments, or goods are like they've got limited cash, so they're looking for maybe a way to kind of ease the burden for paying for goods or services they're receiving. How does that potentially impact like the revenue assessment if a company is offering like price concessions, for example?
Yeah, so the guidance is pretty clear that you have to factor in price concessions and whether you're going to provide them when you're looking at the collectability. And what you have to do is estimate that and then adjust the transaction price accordingly. And then also, if you believe that, well, if the customer's gonna not pay, then you would take that into account as well.
Right. Yeah, that's interesting about evaluating whether their customer has the ability to pay or not, right? I think it can be challenging to conclude that, thinking about that particularly for existing receivables. There's obviously going to be a lot of judgment that's required depending on facts and circumstances. It's definitely important to keep in mind, like I said, if a company cannot conclude that collection is probable at the inception of the arrangement, you can't recognize the revenue.
Mm-hmm.
Any cash you receive, like we said, you got to put like a deposit liability up. All right, let's switch gears to the balance sheet side. So we talked about obviously what could impact what goes on the income statement around some of the revenue recognition and collectability considerations. But when we think about receivables that companies have on their books for the payment they're supposed to receive, I would assume there can be a lot of implications there, particularly for, obviously we got new CECL guidance for most, for public companies right now. And then obviously going into 2023, private companies will have to apply CECL. So thinking about credit losses as they relate to their receivables, I would imagine all this uncertainty, just creating estimates around that, when you think about CECL is about creating an estimate over the loss of the life of the contract itself, can be challenging. Is there any like tips or advice you would like tell people as they're trying to think through, well, crap, what do I need to do about my credit loss reserves?
Yeah, I mean, so CECL, basically current expected credit loss. So, while we've looked at CECL and some companies when they implement it looked historically, we are required to look at it prospectively. So what do you expect? So we have to incorporate the current economic environment. And so, I mean, really going back and looking at your customers and okay, so given that we have a receivable from them, or whether it be a accounts receivable current or more of a long-term notes receivable arrangement, financing arrangement, has the economy impacted them? Do we think that it's impacted them? And then, just kind of assess that. So you probably...
So it's more than just like, because obviously under the incurred loss model, it was a lot of historical analysis, and then just looking at what's going on today, CECL's current conditions, obviously you factor in, use some historical experience, but it's really that reasonable and supportable forecasts where the big question mark is and where the challenge lies, right?
Yeah. So you could look at your customers compared to similar customers that you have some some financial information like a credit rating,
Right.
as an indicator to see how the credit agencies are responding. And then just looking at your customer to see what are their payments? Are their payments slowing down? Are they late? Because that could be an indicator that they're having some troubles.
So a lot of people set up different models. I know the guidance
Yeah.
for CECL doesn't prescribe a specific way how you have to measure the credit loss.
Right.
It gives examples of some ways to do. So there's a bunch of different things used in practice. But what are we seeing, or I guess clients or companies doing with some of their models when they're thinking about the need to revise those models?
Yeah, I think it's important to have a sensitivity analysis because we don't know what's going to ultimately happen with interest rates and the economy, impacted from them. And so having a sensitivity analysis within those models, and so weighing, the probability and the outlook. So, I mean, depending upon what industry you're in, right? Housing industry is going to look different than manufacturing. And so I think, really being prepared and adding some sensitivity analysis.
Yeah. And I've seen a lot of companies where maybe they run like a worst, okay, good, best scenario, and they've got a bunch of different outcomes, and it's just adjusting kind of, like you said, the probability of each of those different outcomes in their models to figure out like what's realistic based on current conditions, and then obviously like what's the go forward look there. So and then I guess I would just add too, for like a lot of CECL models is like there's always the ability to do some qualitative adjustments. So like if you're using more broader economic data to maybe as a starting point for forecasts or things like that, and it's yielding results that maybe just don't make sense, there is like flexibility in the standard to make some qualitative adjustments if you need to. I know one kind of the third area you mentioned was compensation.
Oh, yeah.
And so when I think about compensation, a lot of times it's like, I think one of the more complex areas is a lot of share-based payment arrangements that we see as part of the compensation. And I can see that there could be impacts there with some of the economic uncertainties. For example, a lot of awards, may have a performance target, right? Like, so they've got, you achieve a certain revenue goal or an EBITDA goal, and you vest in these options or these awards or whatever the case may be. Given that there's been like a lot of disruption, a lot of volatility, like there's a likelihood that some companies may look to modify those agreements, right?
Yeah.
Maybe make those performance conditions more achievable, or remove them altogether, or whatever the circumstance may be. But can you talk a little bit about what happens if a company does decide to modify like a share-based award with a performance condition?
Yeah, so sure. On modification date of an equity award, management has to reassess whether it's probable that the original and modified award vesting conditions are met. And so, depending upon whether it went to probable or improbable, the probability of vesting drives what type of modification guidance should apply. So
so there's
just revisiting that.
Right. Thinking through that, there's 4 types of modification. So depending on whether you're going from probable to not probable, not probable to probable, it's a lot of probables in here, but like depending on which way the award went, there's different guidance for how you would subsequently look at the accounting for that as well. And then I guess I'll add, because that's specific to equity classified share-based awards, but for those that are like, maybe you've got liability classified share-based awards that are modified. So in those circumstances, the exercise that you have to go through is a bit more straightforward, because those awards are, essentially remeasured at fair value anyways, each reporting period. So in that case, whenever there is a change in a performance condition, like our example, the company would essentially just recognize the fair value of the modified award using those modified terms on that date. And then another aspect of share-based arrangements that like when I'm thinking through things that could potentially be impacted by just this overall economic uncertainty, especially when we think about the stock market, for example, and all the ups and downs we see in there, is just around volatility. So volatility is obviously a big assumption that's used in a lot of pricing models. So, some companies may be thinking about whether or not they could exclude some of the volatility during the year, like try to argue, well, that's an anomaly or whatever the case may be, because it's so much more significant than maybe historical volatility has been. And so, that's a question I know like I've received from clients before. And so, my usual response to them and what I'll share is that there is a general presumption that volatility data does reflect the broader market. And so even if there is a significant difference in like what companies are historically experienced, it doesn't mean you should just exclude it from the company's estimate of volatility. And I will say the SEC also has a viewpoint on this as well, that the staff has shared and noted that there are very limited circumstances where there can be exclusion of things from a volatility assumption, and even in those very limited cases, it's expected to be what they say is rare. So it's a hard argument to win, I would say. So let's kind of round out our discussion with the last area that we were going to talk about, which was around just like debt and liquidity considerations, which makes a lot of sense. We're talking about interest rates increasing and just impacts to business and customer demand, et cetera, things like that obviously have liquidity impacts as well. So, obviously when there's impacts to cash flows, there's a downturn in the economy. This is going to bring up challenges in those areas. I guess in cases where companies are potentially looking to restructure their debt, for whatever reason, what are some of the things that they need to keep in mind if they're going to kind of move forward with a debt restructuring?
Yeah, so if they're going to move forward with the debt restructuring, you have to keep in mind whether you're basically hitting the trigger for a TDR or troubled debt restructuring. And so
that's the first step you go through, is like evaluating TDR. Okay.
Yeah, evaluate. So in order for there to be troubled debt, for it to be classified as troubled debt, there's two conditions. First, the company has to experience financial difficulties, and then the lender has to grant a concession. So there's a specific guidance on this, ASC 470, to evaluate those conditions. And then you just walk through that to determine whether the modification is a troubled debt restructuring or not. If it's
so if it's not a troubled debt restructuring, then what do you look to then?
Yeah, then you have to decide whether it's a modification or an extinguishment.
So just a general like debt modification or extinguishment. Yeah. Okay. Nope, that's helpful. I'll also add that obviously during these times, like when things are stressed, there's a lot of changes that are often made to debt arrangements. So it could be like extending the maturity date if you've got debt coming due. It could be talking to your lender about trying to change timing of payments, maybe modifying covenants if you've got pretty strict covenants and you're looking at those and you're like, yikes, we're looking a little dicey there, and trying to be proactive around that. But when I think a lot of times when something like that is orchestrated with your lender, the lenders will often charge a fee in order to allow for that modification. And that fee, is meant to compensate for making those changes. And then in the absence of a fee, like sometimes I've also seen where they'll just change the interest rate. And so a higher interest rate is their way to like, more or less basically compensate for making the modification itself. So I think one thing, and I just highlight that because when you're trying to think through the TDR guidance, a lot of times people are like, yes, check the box, we're having financial difficulties. But when they get to that second question about like, has this concession been granted, which is more of a quantitative assessment in reality, a lot of times the fees that are charged or the higher interest rate that's charged by the lender in the absence of a fee, that sometimes kicks them out of like meeting that second requirement. So it may feel like you're in trouble as a company, but you actually don't meet the TDR guidance. So, but speaking of covenants, I guess, so that's another area I know that often troubles some borrowers is debt covenants, especially in trying times. So can you walk through, like, if a company has a covenant violation, how does that impact the reporting of their debt? Potentially.
Yeah, I mean, it could impact the reporting of the debt. If you violate a covenant, and it could make the debt due, right? So then if the debt's due, then it has to be reclassified from non-current to current.
Right.
And, treasurers are usually on top of this. Hopefully, they're monitoring
Yep.
their debt covenants and looking at them. But in doing so, what they'll do is they'll seek waivers and from the lender, and so you really have to assess those to see whether it is going to be a trigger for the debt to be reclassified from current to non-current.
Yeah. I think a lot of times companies, obviously like work with their lenders because they've either failed a covenant or they're planning to fail a covenant. But if they failed a covenant and they get a waiver, I do think some companies automatically assume that holding that waiver gets them out of having to classify the debt as current. It can be non-current, and that could be the case, but you have to also think about, for example, does the waiver more or less provide protection from that covenant at least for a year, right?
Mhm.
And then you have to look at, are there any future covenants over the next year that it's not probable of meeting for the company itself? So if there's more restrictive covenants, like maybe they only waive your failure of your Q4 covenant for 2022, but then they don't waive your Q1 of 2023 and it's more restrictive, you got to think about, like, is that probable I'm going to meet that next one that's coming due? Because if that's not the case, then you probably can't then conclude that your debt is non-current, right?
That's right,
Because there is a failure. So just something to keep in mind versus like if the lender is willing to waive all covenants, for example, over the next year, then, you've got some time to breathe, I guess. So I just like to point that out because I think sometimes people get a little mixed up on, maybe some of the relief that a covenant could provide, or when they're trying to negotiate covenants, they're making sure they're negotiating for the right things. So if we have a covenant violation, for example, and it makes the debt current, I know you mentioned going concern earlier in our discussion, and I would imagine that could have a significant impact on the conclusion around going concern, particularly if a company is worried about the whole analysis is whether you can meet your obligations that are coming due.
That's right.
So let's put debt aside, because I think that's a clear one that could be a huge hurdle to overcome, or may sink some of the going concern assessment unless there's a restructuring of that debt. But what are some other maybe factors that could also be relevant to think through when a company's going through its going concern assessment?
Yeah, so like as a reminder, going concern, we have to assess whether the entity can continue as a going concern for the next year.
Yeah,
right?
And year from when the financials are issued.
That's right.
So it's not year end. So keep in mind kind of when your audit report or you're going to file your financials with the SEC, or your financial statements are ready to be or available to be issued if you're a non-public company.
That's right. And so in doing so, what a company has to do is look at your future cash flow projections, right? And so we just we've been talking about the economic uncertainty, so the future cash flows. So your collections, your AR turnover, also the supply chain disruptions. If you are having a hard time getting raw materials, that is going to impact your ability to sell and product at the end, which is going to impact your cash flows, right? So reduction in revenue, reduction in customer demands. So now also looking at the general liquidity, so the ability to fund your operations for the next 12 months, and then your ability to access lines of credit, other sources of financing in order to meet your obligations.
Yeah, so, and that could be tough. If credit markets tighten, or obviously the cost to borrow is more expensive because the interest rates are higher.
That's right.
So there's also just broader liquidity needs, like you said, that are important to keep in mind.
Yeah, and you're probably going to have to spend a little bit more time fleshing out, providing more information, discussing how the current economy or what you're going to forecast interest rates are going to be would impact your liquidity.
Yeah, sometimes the going concern assessment, I don't want to say it's a roll forward and analysis or memo, but for a lot of companies it can be in more stable times. But this may be a particular year where there's a bit more scrutiny for sure from your auditors as they're doing their own procedures and diligence around that assessment and the conclusion reached there. So definitely worthwhile to spend a bit more time, thinking through that as you go through it for the year end. All right, well, that's, I think, a good place for us to wrap up. I think we had a good discussion, covered a lot here. Obviously, could be many more things that also come to mind. Just wanted to, obviously share our thoughts on some of the more significant ones that we tend to see or get questions around. James, thanks for sitting with me for a bit, and appreciate you sharing your insight. And obviously want to thank our listeners for listening in, and look forward to welcoming everyone back on another episode of Accounting Matters.
Thank you, Adam.